Good morning, everybody, and welcome to the Siler Wealth Management video blog. Today is Tuesday, June 14th, and before I get started, just want to let everybody know that, of course, we know what's going on here in Orlando, and I've been a resident of the Orlando area 34 years, and of course, no one can ever imagine that this would happen in our city, in our town, but on behalf of our staff and myself, our hearts and thoughts go out to the victims' families, law enforcement, and everybody working this situation right now. It's just it's unfathomable, and we hope that of course you can hope it will never happen again, but you know that at some point it will happen again. But let's get through this situation and with as little damage as possible. That's all we can do. I wasn't even going to give any market commentary today because I think everybody has kind of a black cloud, but I think it's important for me that give information to my listeners and the folks that actually come to depend on what I'm saying to help them kind of get an idea of what's going on economically or stock market wise. So I want to keep going on business as usual. So let me go on and first say the markets are the economy chugging at a very slow pace. Now may have something else to deal with. Many of you may have heard of Brexit. Brexit, all right, that is the potential British exit of the European Union. Now, the Brits have their problems, and they want to get out of they're going to take a vote on June 23rd to get out of the European Union. Now, they still have their pound sterling that they use, and the main problem is the trade situation, because they do have free trade within the European Union, the 28 countries that make up the European Union. So it looks right now that they're going to vote to exit. There is a 10% lead to exit the European Union. What does that do to the world economy, stock market? Well, nobody knows right now. You're really not sure. There are some estimates saying that it could hurt the British economy by 6% over the next several years. Some people say that it could increase their GDP because they can cut a better deal when it's all said and say, we're out, but you still want our trade, because they do export a lot. So we're really not sure. What I do know is that the stock market does not like uncertainty. And that is uncertainty because no one knows what's going to happen if the Brits do exit the European Union. Now, what's been happening is there's fear in Europe, for sure. And this is something that is unprecedented. The 10-year German Bund, they call it the Bund, but it's really the bond, the 10-year German bond, has turned negative for the first time in history. Here's what that means. That means the German 10-year bond has a negative interest rate. You've probably heard that term a lot lately because there's negative interest rates all around Europe. What that means is, let me take a step back and give you examples. When you invest in the U.S. Treasury Bonds, you're loaning the U.S. government money, and they're paying you a nominal interest rate. Okay, so in our case today, if you give the U.S. government $1,000 for a 10-year bond, that means it matures in 10 years, they're going to pay you 1.61% per year for the next 10 years, and at the end of that term, you should, based on the full faith credit of the United States government, get your money back. Negative interest rates is that you give the German government, for example, the two-year German bond, you give the German government $1,000, you have to pay them 0.5% to hold your money. That's a problem. Negative interest rates are bad for the economy, in this case, the world economy. So what is that doing here in our country? Well, because there are negative interest rates all over Europe, that money is what they call flying to safety or a flight to quality. And they're looking for safe investments. Now, what's considered a safe investment? U.S. Treasuries are considered very safe because we're full for the United States government, okay, and we pay our debt, although our debt is mounting. So money from overseas is flowing into our safety, which is our U.S. Treasury bonds. Now, what happens in any situation? The stocks, the car market, the painting market, the fine art market. If there's a lot of demand and people are buying this fine art, what is going to happen to the price of that fine art as supply starts to dwindle? prices go up. So in the cases of bonds, as the price of our bonds go up, because there's buying from all over the world now, because who wants to, in their right mind, wants to give the German government money and then say, hey, here's some money to hold my money? That doesn't make sense. So money is flying into the United States to buy treasuries. Price of the treasuries going up, and what happens to the yield of the bond? Just recently, we were over 2% yield on a 10-year treasury. Now we're 1.61. Well, because the value of the bonds have gone up, the yield goes down. So when you have interest rates that are low and dropping, that gives you concern, economic concern, because low interest rates are typically a tool used to spur growth in an economy. So we are now at a point where our rates could go much lower. Now, what's that good for? It's good for refining your mortgage. You may have another shot to refinance your mortgage. You may have another shot to buy a house at a low interest rate. It's because rates were going up. Now you can get mortgage rates at 3.5% probably. But it's not a good sign about the world economy. So as the world economy goes, so does our stock market. And I've been saying and kind of giving you a little bit of a heads up, I don't see a bear market. What I do see is a correction. And I think we're starting to see that now. And again, the market does not like uncertainty. And that's what we're seeing. So you got to really have a defensive posture. And we've been planning for this for a few weeks in our money management. So we're prepared. So what do you do here? Well, I would put some tight stops into some of the, if you own individual stocks, put some protection in, put some tight stops in. So if something drops, hey, you're out, take your profit. I would probably, and right now, and I'm a big fan of the financials, I wouldn't buy any more financials right now because lower interest rates are not good for financials. Financials like rising interest rates, and that's really good. I would probably be okay still with energy. I'd probably be okay with healthcare. We have sold pretty much all broad-based mutual funds that are a broad-based exposure. I mean, we're real concerned about it. I like things that have an interest rate or a nice dividend. So, you know, we have some real short-term type bond situations, some floating rate, things like that. Floating rate does better in rising interest rates as well. But it's really a difficult market right now, and I just urge you to be careful. And if you have any questions, and you know, you can't just ride your 401ks down and let them go down 20%, 30%, because I don't think we're going to see that, but you never know. So anyway, I'm not trying to be doom and gloom, because I'm not, because I think it's just a correction coming. Now, between Brexit, you still have your problems in China. I mean, you know, which is interesting. Financial reporters are getting arrested in China because they're saying, hey, our economy is not as good as the Chinese government's saying. So they're getting arrested for that. Okay, so we know that the Chinese government, certainly their economy is not doing as well as they say it is. Earnings, we're probably in an earnings recession. Earnings were not good this last quarter. And we have the presidential election. We have the terrorists. I mean, so right now, really, discretion should be the better part of valor. Just going back in sit-back mode and look for some opportunities, alternatives, not in the stock market necessarily. And I keep talking alternatives, and alternatives are a great place to be, things that aren't correlated to the stock market. And I could discuss that with you. Okay, now, a week from tonight, we are women investing full. All right, that's not happening, so you cannot sign up for tonight. A week from tonight, if you have stock market jitters, which you should, just go on our website, sign up for stock market jitters event, and we have room for that right now. But women investing is booked. We do not have any more room, and that is tonight. Anyway, that's all I'm going to say for today. Markets are indicated lower. Just be careful out there. If you need any help, call us. We'll be available to you. We are setting aside a couple days a week to meet with new people that want to come in and talk about your portfolio. Hey, not a bad thing to hold some cash on the sideline, okay? You never know. But I'm Lee Seiler, the Stock Doctor. My website, stockdr.com. I hope everybody has a fantastic day, and I'll be back with you on Thursday.